All righty, we're going to jump into the analysis of a potential rental property. If you want to check out the deal analyzer that we're using, go to the description and you can see the link to DealSimple there. Without further ado, let's jump right in. So we're gonna use, say the purchase price is 250. Closing costs. Now, how you come up with this, if you're newer and have never done a deal, the closing costs are really going to be um, determined by the different market that you're in, and also the size of the property in terms of dollar figure. So a more expensive property, this percentage is going to be lower because a lot of those costs are going to weigh less, and it's going to be an overall lower percentage based on the purchase price. Now, if it's a a $40,000 house, then these closing costs represented as a percentage are going to be higher, because a lot of the fixed costs like appraisal, lender fees, that kind of stuff, that doesn't change whether it's $1 million house or a $10,000 house. So my suggestion, if you're newer to this, is get with a reputable title company that's local in your area, and they'll be able to help you go over the different closing costs, and give you a good conservative rule of thumb to use. So in our market, in the Northern Virginia area outside of DC, on a purchase price like this, probably be somewhere around 2.5%, I would say. Um, Actually, it'd be probably a little bit lower, but we're really not talking about much of a difference going from 2.5 to 2%. So I wouldn't get too tripped up on this. Now, credits would be anything like, if you're a real estate agent and you're representing yourself, you're going to get a commission. You would more than likely apply that commission towards any closing costs, and you would put that here. If you're getting any kind of lender credit or seller credit, you would put that here as well. I'm going to leave it blank. We're going to assume that we're not getting any credits. Now, the reno budget on a rental, it's probably going to be less than a flip or a burr. Those are usually a little bit more reno intensive. So I'm just going to put $10,000. New paint, new carpet, maybe some repairs here and there. That should be good. And then this reno holding costs, we have that here, and that's any renovation costs that you incur while the renovation is taking place before you actually get a tenant in the property. Usually the utilities are slightly higher. They're pulling more power, more water, while a reno is taking place. So any costs associated with that would go here. So I'll just put, I don't know, 750. And then the ARV, this is not going to determine anything to do in our spreadsheet. It's not going to determine anything with the loan, or anything like that. What this is used for is the estimated property value moving forward. So if you think that you're buying the property below market and simultaneously you're putting some money in and it's smart money that's going to add to the value, then maybe the ARV here would be 75. But again, doesn't influence the loan. The loan here is tied to the purchase price. So loan points or fees, this is going to be anything charged by the purchase lender. So if you're buying down the rate, right, rates are high right now as of recording this. They're in the fives or sixes. I don't even know exactly where they are right now. We primarily deal with commercial, so but I believe they're somewhere around the fives or sixes. So if you wanted to buy that down, pay a point or even 2 points to buy that down, you would put that here, as well as any lender fees or charges, anything to do with that. A lot of lenders just have a flat origination fee. So you would add that here as well. So I'm just going to put that the lender fee and points that we're using to buy down. I'm going to say it's just 1%. So 2,500. And then the interest rate, let's say we bought it down to 5%, which sounds kind of crazy that you'd be buying it down, but that's the current current state of affairs. Loan to value, I'm going to say 75. That's typically what it'll be on an investment property, or even less, probably somewhere around 70 to 80% is what you should use. But again, I would get with the lender and just confirm all that beforehand. Amortization, if you're doing a typical Fannie Freddie loan, a conventional loan, it's going to be 30 years. You can do 15, but just for the sake of cash flow, let's just stretch it out to 30. Rental income, let's just say it's 1 unit. Now you can add more units. Certainly is not I wouldn't use this if you're looking at a 100-unit multifamily property, but if it's a smaller unit property, then it should suffice. But for the sake of this, we're just going to say it's a single family house, 1 unit. Average rent, let's say it's, I don't know, $2,000 a month. Other monthly income, this would be, any pet fees or anything associated with that. Maybe there's lawn, if you have a 4-unit property, maybe there's shared laundry and you would charge for that. So I don't know, put in $25 here. Annual vacancy, let's use 5%. That's a good rule of thumb. If you want to be more conservative, then by all means go higher, but 5% should be fairly conservative. Estimated property taxes. So you're going to get this from the annual property tax you're going to get from the county, wherever you're looking at, the county that the property is in. You'll be able to typically, now I'm in Virginia, some counties in West Virginia or even in Southern Virginia, it's like they operate and they're stuck in 1986 and there's no online presence or anything. You have to call and get all that info manually. But typically the counties will be, they'll have all this information online, and you can type into Google, I'm in Prince William County, Virginia. So, that's typically where we operate. I live in Loudoun County. So, I'd type in Loudoun County, Virginia real estate assessments. And one of the first results is a database that shows all that information, the different sales that have happened on the property, what the property is assessed at, what the tax bill is. You can get it down to the penny. So for this property, I'm just going to put in, I'm going to say it's about 1% of the purchase price. So 2,500. Annual insurance costs, I'll say, is $1,000. Again, I would check with every property is different. If it's in a flood zone, that's obviously going to impact things. We've seen that. And, depending on if you're going to do Airbnb, it's going to be higher. If you're going to do a traditional 12-month lease, it's going to be lower. So I would just get with a good insurance agent to figure that out. But for this, I'm going to use $1,000. Property management, let's just say it's 10%. Again, if you're doing this as a short-term rental, like Airbnb, Verbo, those kinds of platforms, then and if you're looking to get someone to manage it, it's going to be higher than this in all likelihood, unless they're just doing the back end management and not dealing with setting up cleaners and that sort of thing. But and if you're doing it as a traditional 12-month lease, then 10% should be on the conservative side. I've seen them less, but for analyzing it, I would always be conservative. So monthly utilities, again, if you're going to get a 12-month tenant, you're more than likely going to put the utilities in their name. So you would just leave this blank. But if this was a situation where you weren't, like, if you were living in a property, if you were looking at it like a house hack, you're living in a portion of the property and then you're renting out a portion of the property, you obviously don't meter those separately. It's one utility bill. So you would more than likely just either charge the fixed amount every month, you would or you just build it into the rent and just have it flat. I guess you could go back and you could look at each month and kind of parcel it up based on their usage. You know, if they're renting out 25% of the house, then they would pay 25% of the utility bills, but that's getting a little granular and probably isn't worth the time. And in every situation where I've house hacked, I've always just added it to the to the rent. So I'm just going to leave this blank and we'll assume that it's just a tenant where the utilities are put in their name. Monthly maintenance and repairs. I would check with, again, this is all going to depend on how you're renting it. If you're doing a 12-month lease, it's probably not going to be as high of a budgeted line item as opposed to if you're running this as a short-term rental like Airbnb. Typically stuff breaks, and also the guests, they really demand a higher quality product, where everything is tip top. So I'm just going to put, it seems, I'll just leave that in there for now. We can tweak that if it looks low once we see all the numbers. And then this would be any expenses such as HOA, condo fee, that sort of thing. So let's just put in a $50 a month condo fee. And then here are the assumptions. Now, this is where you can make or break a deal, and it's really garbage in, garbage out. So if you put bad assumptions, like if you assume 10% annual rent growth and 1% expense growth, that's not conservative at all. What I would do is, 3% rent growth, 2% expense growth. If you really want to be conservative, make the expense growth and the rent growth the same. But for this, I'd feel comfortable doing 3 and 2. And then for appreciation, again, I'd probably do somewhere around 2 or 3%. Let's just do 3 just to see what that looks like. And then selling cost, and to elaborate on that, this is the amount that you're assuming the rent is going to increase year over year. So every year we're expecting it to go up 3% based on the prior year. Same with expenses. We're expecting every expense to go up 2%. That includes taxes, insurance, property management, or actually no, property management wouldn't, that's tied to the income. But every other expense we're assuming that it's going to go up 2% every year. Now, the year over year appreciation is how much you think that the property is going to increase in value year over year. Again, if you really want to be conservative, then use 1 or 2%, but 3% should be okay. But again, it depends on what market you're in. If you're in a real stagnant market, then you probably want to look at what's been going on there. And I would take out the COVID years because appreciation was insane during those years. But anyways, if you use 3%, that should be okay. Selling costs, this factors in any realtor commissions as well as closing costs that you'd pay. So if you're paying 5%, 5% full service to the both buyer and selling, both buying and selling agent, that 2.5% each, that's 5%. And then another 2% in our scenario where I live, 2% for just the closing costs. That's settlement fees, grantor's tax, the different congestion relief taxes that you pay, all that adds up. And generally it's only around 1%. But again, I always like to be conservative. So let's use 5% for the agents and then 2% for the actual closing costs. That would be 7% total to sell the property. So now let's calculate, see what comes out. All right, let's see how this one looks. So here you can see the rent, you can see it increasing based on the assumptions we put in. Same with the the other income. And then here's the vacancy, and here is basically your top line, what you're bringing in after backing out the vacancy. So that's this row right here. Now here's all your expenses. So your net operating income, which is the gross income minus the expenses, that's going to be on this row right here. And then below that is the debt service. So that's the loan. And how we have it here, it's a 30-year fixed loan at 5%. And here is the total debt service. Obviously, your mortgage payments, 30-year fixed, it's never going to change. That's not factoring in escrows. So this is you typically will escrow taxes and insurance, but if the loan to value, I used to be a loan officer, and if the loan to value is less than, I believe, if it's 80% or less, you don't have to escrow. You can pay it yourself. I've always escrowed it just because it's one less thing to deal with. You're basically putting that responsibility on the lender, and also they like to be in control. They want to make sure that the taxes and insurance are paid so that their collateral is safe. So you actually will usually get a slightly lower rate when you escrow taxes and insurance. So that's the total debt service for each year, and you can see the breakout between the principal and the interest paid. And then you arrive here at your annual cash flow. That's that line right here. And below that are some of the numbers based on the assumptions that you put in. So this is the estimated value of the property. You can see that the equity increases with that as the loan is paid down and the value goes up. More equity is created, obviously. And then here is the total proceeds if the property were sold, and that's factoring in the 7% that we've allocated towards the selling costs. So for realtor commissions and the closing costs. So hopefully this was helpful and gives you, one last thing. These are some KPIs right here, just to kind of give you the deal in a nutshell. You can see if the numbers make sense. The cash on cash is probably a little bit lower than what somebody would like. Depending on the market. This one, where we are in Northern Virginia, it seems like the cash flow is lower, but the values here are continue to increase. And we're near DC, and Amazon's headquarters. They're coming in here, and people are sort of betting on appreciation. So cash flow is definitely hard to come by in this area, whereas appreciation over the past several years has been good. So but again, that's all market dependent and changes based on where you're at. But so yeah, those are the KPIs. Again, hopefully this was helpful. You got some value from this. If you want to check out DealSimple, which is what we're using here, we made it simple. We like it that way, and everything's on one screen as opposed to multiple screens, and where it's overly complex. Anyways, if you want to check that out, go to the description and you can see a link. Thanks everybody for watching this, and have a great day.